Welcome to a presentation on long-term debt for the town of Hingham. With me is Gene Montgomery, our treasurer, and I am our town administrator. Thank you for joining us, and I'd like to take you through a series of slides that will show you how we manage our debt and help us deliberate upon a decision to issue debt short-term or long-term, and especially interesting and concerning in this interest rate environment. So if I could take you through our first slide, which is financing debt in Massachusetts, and I will start out with Massachusetts General Law, Chapter 44, is the body of law that allows municipalities to issue debt. And it covers all of the procedures for municipalities to issue debt. The purposes that municipalities issue debt for are predominantly cash flow, financing the acquisition of capital assets, construction and repair of infrastructure, and the refunding of existing debt. In Hingham, it's predominantly the latter, the financing of capital assets and the refunding of debt. As we've moved to quarterly billing many years ago, we were able to avoid cash flow issues, so we bill quarterly on real estate taxes, and we no longer have cash flow issues. Many people know that we just about finished a middle school, and that is a prime example of how we use debt to finance long-term activities. So short-term debt. When we begin a capital project and a construction of the middle school, for example, a great example, is that we start out with short-term debt, which is a note that we issue for a one-year period of time. The payment is due within 1 year with interest and full principal, and then what we do is the following year we reissue another note, and those annual notes are called short-term bands or bond anticipation notes. The other types of short-term debt, we don't use them as much. They're TANs, tax anticipation notes, and SANs, grant anticipation notes. The TANs are for communities that need to deal with cash flow issues. Real estate taxes come in each quarter or semi-annually, and they can't pay the bills in between. So they issue a tax anticipation note, pay it off when the revenue comes in. We have used a SAN in the past, but very rarely, and that's when we're going to get grant proceeds, but we need to spend the money first and then get reimbursement. And if we don't have the cash flow, we would use a grant anticipation note. Hingham has had a very strong cash flow for many years and not required to use this financing procedure. Long-term debt, which is referred to as a bond, involves loans with maturities of 12 months or more. And generally, we issue those bonds in 5, 10, or 20-year increments. All debt issuance requires the 2/3 vote of town meeting to allow us to begin to issue debt, whether it's a short-term or a long-term debt project. The bond payments are annual, with interest payments semi-annual over the life of the loan. The vast majority of municipal debt is calculated as simple interest, level principal, and therefore we call declining debt service. So, for example, if you issue a $20 million bond for 20 years, we are going to make $1 million principal payments for a 20-year period of time. And therefore the interest would decrease. So it's a little different than your home mortgage, where it's a flat payment for a number of years. Chapter 44, Sections 7 and 8 are the areas of the law that detail what the town can use and how the town can utilize borrowing. Chapter 7, Section 7 lists the borrowing purposes that are subject to the debt limit, and Chapter 8 lists the subjects that are not. And the items that are not, and without going into the specifics of each individual separation, the general separation is that debt that is within the debt limit is debt that is part of your core operations that doesn't have another financing source, and debt outside of your debt limit are projects that have independent financing sources. So they tend to be your water and your sewer projects that receive revenue from those activities. That's the general rule. There are some exclusions, which I just addressed. However, one aspect of the exclusion is that I wanted to point out is the debt ceiling. And the debt ceiling limits the town's ability to borrow. Gene will move us into that next screen. And the debt limit is 5% of the equalized valuation of the community. The equalized valuation of the community, a very technical term for what's the full and cash value of all the real estate within the community. In Hingham, we're close to $6 billion, and 5% of that would be your maximum allowable debt limit. However, it is possible to increase that debt limit to 10% if you were to petition the Emergency Finance Board. I'm not aware of very many communities that do that, and I would certainly say that no community that would be a AAA rated community would exceed the 5% threshold. To give you an idea of what the volume of these issues are, is the EQV for the town of Hingham is $5.9 billion. 5% of that would be approximately $300 million. Hingham's net debt subject to the 5% right now is $38.7 million. So you could see that we're about 25% of what we could, or 20% of what we could actually issue in debt. We could legally issue another $250 million, which we have no intention of doing. So when we issue debt, the financing team, we are the issuer. And so our team includes myself as the finance director, the town accountant, Sue Nickerson, and of course, Gene Montgomery, our treasurer. And the three of us are the employees in the organization that manage the debt program. Bond counsel, external to us, is retained by the town to prepare the legal documents, to review the authorizations, review the official statements, review the side documents, the sale side documents, but most importantly, render an opinion on the validity of the bonds and their tax-exempt status. Municipalities are entitled under IRS code to issue bonds that are exempt from federal, and if they're within their state, from state income taxes. This is the powerful advantage that we have. This gives us access to capital at a lower level than any other organization, because investors can take advantage of the returns or the yields on the bonds and not have to pay federal or state income taxes. The ability to do that has to be detailed by bond counsel to say that we've followed the proper procedures in order to allow that tax-exempt status to be extended to the bond holders. The other key external entity that works with the financing team on the bond issuance would be our financial advisor. And they work with us internally to help us develop our plan. They prepare and circulate the preliminary and the official statement, notice of sale and bid sheet. They market the issue, they sell the issue. And as we sit with them, they manage the short and long-term discussion that we're going through right now. And they provide us data and help us understand the marketplace, because while we are competent municipal financial minds here, all three of us, we're working for one community, and these experts work for hundreds of communities, so they get a better view of the marketplace, and that information is very valid. Two other things that that financial advisors do for us is they help us with continuing disclosure, and they help us with the final selection of the actual bond, and they help us with the rating agency reviews. And they will interface between our financing team and the rating agencies, Moody's, Fitch, or S&P. Those are the three entities that give us the designation that we're looking for, the AAA rating. And financial advisor helps establish the setting with which we answer their questions. The underwriter is essentially the buyer. And this is where the financial advisor interfaces almost independently of us. We do not communicate with the buyers directly, and we allow the financial advisor to do that. The bidders submit lowest net interest cost bid. That's how we calculate our bids here in Massachusetts. So it really is not a discretionary process. The bids come in, they're calculated mathematically, and the lowest bidder gets the bids. We mentioned some of the other players to the process of issuing debts. We have the rating agencies, Standard & Poor's, Fitch, and Moody's. Communities are required to get better access to market, at least have one rating agency. Many have two. Hingham is one of the few that has all three rating agencies. We have been rated a AAA by all three since 2002. Very unique, one of the only communities in the Commonwealth that has that. And we are all also known as a natural AAA, which means that we do not buy an insurance product, which many of the AAAs, I would say well past 50%, prior to 2008, the AAAs within the country were insured AAA products, where the governmental entity bought an insurance product from another company that guaranteed their bonds, and they were sold at a AAA level. For us to be natural AAA provides a better comfort level to the bondholders, because they don't have to worry about a second entity being financially viable. They can just look at us as the entity, determine our financial viability, and make an investment decision on their own based upon that. And as we saw from 2008, a lot of those investment contracts, insurance contracts on bonds, proved to be worthless when those insurance companies that were providing them went into financial difficulty during the crisis of 2008 and 9. So moving on, temporary borrowing. And that's what we're talking about today, largely. And so we've gotten past the overview of how we borrow. If we can continue on, the town of Hingham has special legislation that allows us, in 2008 we were granted special legislation that allows us to continue issuing temporary bonds, those one-year notes we called bands, into perpetuity. The traditional structure of financing requires municipalities to issue long-term debt after 2 years on all non-school related issues. And so that requires them to move into the long-term financing very quickly. In 2008, we filed a home rule legislation, House Bill number 4236, and it was approved later that year. It allows Hingham to issue those short-term notes for the life of the approved debt issue. For 20 years, we could issue 20 successive notes each year. And the requirements are that after the second year, where all the other communities are required to go to long-term and start making principal and interest payments, we can continue staying in short-term and pay short-term rates, but we have to make a principal payment of the same equivalent had we gone long-term. And so the law does not allow us to avoid paying the obligation by just simply paying interest, but it does allow us to essentially access the short-term market as opposed to the long-term market after 2 years. And the purpose of the presentation that we're going to go into from here on out will help the community decide whether or not that is a good idea or not. And here we are, looking at the option of whether to finance long-term or short-term. So we're going to take us through a series of charts now that will detail to you the analysis that we're working through to determine whether or not this is a good idea for the town. I will start out by saying that I've heard from a number of people in town that they would like for us, the financing team, which in this case I would expand to our financial advisors, to give a specific recommendation to the community. That will be difficult here. The reason it will be difficult here is that we're going to talk a lot about risk. Risk is an individual subject matter, and it'll be virtually impossible for the financing team to tell the community what their risk tolerance is in this issue. So I want you to keep that in mind as we're moving through this. And we'll give recommendations and guidance, but at the end of the day, the community needs to decide how they want to handle this issue. Just give you a brief overview about the legalities and things that we have to face when we deal with a debt issuance. Federal legislation requires us to focus on arbitrage. Arbitrage is borrowing money rather at one rate and investing it at a higher rate and earning a profit, a gain. The IRS code limits municipalities' ability to do that, since they're providing us with a tax incentive to have lower rates in the marketplace. If arbitrage didn't exist, then the first thing I would do is ask Gene to issue $1 trillion of debt and borrow and put it in the bank and earn 15 basis points difference, and I wouldn't have to have any property taxes for the town of Hingham. The federal government would probably have a significant problem with that, since that's not the purpose of providing tax-exempt financing. It's to allow communities to build things like schools, police stations, fire stations that they need to run their operations. So that's the concept of arbitrage and why it's important, and why it's very important for the towns that issue debt to make sure they don't violate those provisions. The violation of those provisions could require the IRS to declare the bonds taxable, which means the bondholders who had purchased these debts would be very upset and would likely litigate immediately with the town for violating the covenants that turned their investment from tax exempt to taxable. The SEC, Securities Exchange Commission, is the body that requires municipalities or all debt issuers to do continuing disclosure, and that we continue to do that. State legislation we talked about, Mass General Law, Chapter 44, Chapter 70B, school borrowing issues, and the SRF is a state revolving fund for water and sewer issues. And I mentioned earlier the local legislation, that Chapter 427 of the Acts of 2008, that allow us uniquely as only one community in the Commonwealth to issue short-term debt into perpetuity. We went through this earlier in our discussion. Things I will point out is that regardless of the ability to issue debt short-term on an annual basis, each process has to be a competitive sale or a negotiated sale. The town of Hingham has always used competitive sales. We just don't feel there's a value to negotiating a sale. Usually a negotiated sale is when there's a complex transaction and your rates are going to be higher. We receive outstanding rates because of the competitive process, and we've been doing that for, I believe, 30 years. I don't expect that we would ever change that. The key aspect of our legislation, and really what the town has to grapple with here, is the ability for us to introduce variable rate financing over the duration of the loan into our financing structure. Previously, we were just a fixed rate organization. We issued, when we built a building, we issued a short-term note for 1 year at a fixed rate, rolled it over for a second year at a fixed rate, and then issued an 18-year note at a fixed rate for the remainder of the 20 years that we were going to issue debt for that project. Now, with this legislation, we can actually issue 20 individual notes. Each note will be based on the market at that time, which essentially means we have the ability to issue 20-year variable rate, annually variable rate adjustable debt. What you have here is a 30-year graph of interest rate on the 30-year AAA rated bond. And what you can see on the far left of the graph, this chart goes from 1981 to February of 2012. And in 1981, where we know rates were extremely high, if you can remember those days, you can get a certificate of deposit at a local bank for about 18%. Municipalities were paying as high as 13% on their 30-year bonds. And what you could see is over the next 10 years, that continued to decrease to around 6%, stayed roughly within that range before moving under it, and consistently has stayed under that for the last 20 years, moving below 4% regularly within the last 10 years. This chart is depicting the long-term 20-year bond rates over a 10-year time period as compared to the short-term 1-year bond rates over that same 10-year period. So from 2003, you can see the pink line, or the top line, is roughly starting at 4%, continuing on mostly through 2008 at 4%. We see a spike during the financial crisis at the end of the year in 2008, up to about 5%, and then we see a very precipitous fall down to 3 over the next couple of years. Some little bumping, as we've seen in the marketplace, and then a continued decrease all the way down to a low of 2% in fiscal 13, and now within the last year an increase up of 3%. And of course, now this is the meat of the conversation. What you can see here is that for roughly 15 years of the past 20 years, 20-year bonds have been selling at about 4%, with a slight bump up to 5 in 1 year, and then decreasing dramatically to 2%. Now we're seeing it go back up. And the questions faced to the community is, do we quickly issue long-term debt right now and capture these historic long-term rates before they go back up to the 4s, or if we look at previous charts, to even higher numbers? That is what we call market risk. And it's the risk that rates will move further up for us. And we're contrasting that against the bottom line, which is a short-term rate. And over the last 20 years, had we issued short-term rates, short-term bonds exclusively, we would have started out at 1% rates for the first 3 or 4 years, going back from 2003 to 2004. And then in 2005, the rates started climbing dramatically. And they went from 100 basis points to essentially 400, a little under 400 basis points during that period of time. It's interesting that that period of time also preceded the economic collapse. And so perhaps this is a message to us as to what happens with short-term rates as we're getting ready to focus on what might happen next. But then you can see what happened after the economic collapse, and those rates fell dramatically. They went past their historical averages all the way down to what has been for the past 6 years now, historic lows. This is, again, the meat of the conversation. Should we issue debt at 10 or 15 basis points annually, expose our organization to market rate risk of long-term rates going up, or should we immediately issue debt at a higher rate, 3%, and live with what is historically a lower long-term rate? However, I got to say that again.
You posed the question,
should we issue debt now and capture those long-term rates at approximately 3%, 2.5% to 3%, or should we take advantage of the short-term rates that are approximately 15 basis points? And the difference is about $1 million a year, which we'll show you on future graphs. And what would we do with that million? Well, we would plow it back into principal, just like you would in a home mortgage. If you paid your principal off earlier, it would shorten the life of the mortgage, and it would provide you with the maximum gain or reduction in interest costs, which in our case are paid by the taxpayers. And that is the heart of our conversation. And we're going to take you through a series of graphs that try to give you some sensitivity as to what the risks are associated with this activity. In the first part of the graph, we have the 2002 general obligation bond. Quickly, the town of Hingham has issued general obligation bonds in approximately every 5 years or so. 2002, 2007, and 2009, we're getting ready to issue another one, whether it's a short-term one or a long-term one within the next year or so. Even though we've had more projects than just these 3, we allow the projects to stay in short-term until we can commingle them to a larger long-term issue so we can gain some economies of scale when we go to the capital markets. And what you can see here is in the left-hand side of each of these bar graphs, that the cost of issuing the debt long-term versus the cost of issuing the debt short-term. And you could see in each case, if we had stayed in the short-term market, we would have gained substantially. But of course, we know that when we look back, because we know that long-term rates for the last 20 years from the graph we just showed you have been higher than short-term rates. So again, hindsight being 20/20, what we're talking about would have worked beautifully the last 20 years. What we don't know is whether it will work beautifully the next 20 years, and that's the purpose of this conversation. So this chart will depict the 2002 issue, the first issue from the previous slide. And what Gene has done here is walking us through what would transpire should we stay in a short-term environment for that. And what we did is we applied the actual short-term rates that we've known, because we've issued short-term debt for the past 20 years, and we've compared them to what the total debt service for the project would be. And you could see here that had we stayed in the short-term market for this particular issue, the town would have realized savings on a $48 million or $62 million total debt service. They would have realized savings of almost $15 million, $14.7 million. Substantial savings. So this is what's brought us to this discussion. We're not talking about risk for a small gain. We're talking about risk for a very large potential gain. It's over 20% of the project cost. The next chart shows what we would have done had we applied the exact process that we'd recommend in this case. The previous slide just compared short to long term, but what we're talking about is taking those savings in the initial years and putting them right into principal. And the advantage of that, of course, is we all know that in any stream of payments, the ability to make an extra payment is enhanced if you do it in the first year. And so by doing that, we can see that the savings would have increased from $14.7 million to $15.7 million. So we pick up another $1 million just simply by taking our savings and rolling them into the loan. Again, very similar to what you would do with a home mortgage. If you pay your mortgage off by making extra payments earlier in the loan rather than later in the loan, you're going to save much more money on the interest. The second issue that we worked in, a smaller issue. If you recall from the first graph we showed, there were 3 issues on the graph. 2 were very large general obligation bonds in the $40 million range, and 1 was smaller, and this is the smaller one in the $6.5 million range. The interest rates were also smaller, and so of course the savings are going to be smaller, but still rather substantial. On a total debt cost of $8.9 million, we're talking about saving $1.8 million. Again, we're talking about almost 20% of the debt issue. So while it's a smaller dollar number, we're seeing the same percentages, which is healthy for us to get a sense of what the ramifications or what the gain potentials are out there. The third issue shows us the exact same thing. And in the third issue, it's a $38.5 million issue. The total debt service cost on this over the life of the loan would have been about $53 million. And we're talking about savings of almost $12 million. Again, if we rolled those savings into the beginning parts of the loan, those savings would have extended up to $13.5 million. $13.5 million of savings on a total debt issuance cost of $53 million. And so we're talking again about numbers in the 20, 23, 24% range, very substantial. This chart is a summary of what we've just talked about on the previous chart, several charts. And as you can see, in the far right-hand column of each of these, we're looking at projected savings that are well above 20% and as high as 25%. In some cases, had we applied the principal payments, the interest savings to principal payments, as we're suggesting the town consider for the current issue that we're dealing with. So up to now, we've taken you through the history. And now we're going to move into the future, and we're going to do some sensitivity analysis on the next few charts to try to divine what could happen and to show the range of potential outcomes and the risk associated with it and the rewards associated with it, so that the community can come to a conclusion as to what's in the best interest long term. This is probably the heart of the conversation and really what people need to focus on to make the decisions that they have to make. The first chart that Jean has calculated shows our current debt issue that we're planning to take to market in the late spring of 2015. It's a $45.5 million general obligation issue, and it is a combination of the middle school project and several others that have been approved over the last few years that we will, as I said, commingle together for economies of scale in issuing the market. And what we're trying to do here now is much harder than we've done in the past, because we don't know what interest rates are going to be in the future. If we did, it would be very easy, just like the past, and I could tell you which your course would be and what your gain would be. So what we show here, in the first column, of course, is the principal amounts, and we show it decreasing as payments are made against it. In the second column, we show the projected interest rates. And what we do is we start out with what we think the interest rate will be for this year, which is 0.14% or 14 basis points. Then we increase it by 10 basis points for the second year, and then we increase it by 25 basis points after the second year, and we continue that all the way down until we get to 3%. And we continue out saying that, in this case, what we're saying is short-term interest rates will follow this pattern, that they will elevate over the next few years by about a 25 basis point clip until they peak out at 3%. I want to be clear, this is simply an assumption, our estimate of what we think the future could hold. And this is where people, again, have to focus on their interpretation of the accuracy of this. So our next column, the annual debt service column, is our measuring stick. This column represents what would happen if we issued debt for the remaining life of the loan, 17 years, in the spring as a long-term bond fixed at 3%. And that would be our debt schedule that you can see in the fourth column on this chart. And so what we're going to do here is compare the gain that the community would receive by staying in the short-term market as compared to this debt issue that we just identified. And if you move over to the fifth column, you can see the projected debt service. And that debt service is applying the short-term rates that we see in the second column. So we're taking our assumptions now, we're applying it to the data, and we're coming up with a savings. The last column shows the gain by deploying this strategy, assuming the assumptions were correct. And we're seeing that on a $57.7 million issue, you could realize a gain of almost $7 million, $6.9 million. The next chart shows what would happen if we took those gains, like we did on the historical data, what would happen if we took those gains and deployed them into the first few years of the debt schedule. And if we did that, it's depicted in the fourth column there that Gene is highlighting, we would see that the savings would increase from $7 million to almost $8.8 million, a rather substantial increase. So now we're looking at saving about $8.7 million on a $57.7 million total debt issue. Extremely high ratios, which, by the way, are very consistent with the historical schedule of what's transpired in the past. And again, I want to keep saying, because we all know it, we've seen it in the prospectuses, past performance is not an indicator of future success. So I don't want people to think that just because it happened in the past, it will happen in the future. But we do have to look to the past to try to gain some sense of what will happen in the future. And Gene's thrown this on, and you could see, the numbers are fairly consistent. So if we can move to the next chart, what we see here is a much broader sensitivity analysis by depicting a group of scenarios happening, and so that we can see what happens when we modify our interest rate risk assumption. So as we roll in the proposed project to the previous chart that we showed you about the historical comparisons of how we would have done with our previous debt issues had we used this strategy. Those are depicted in the first three lines of each of these graphs. And then we've rolled into 2015, and you can see that the savings are not as great as they were on the previous issues. I'm not sure this is accurate, but I'll tell you why we're projecting a lower savings. And we're projecting a lower savings because we've taken a very conservative approach, we believe, on what we think both the long-term rate will be going forward, we elevated it, and the short-term rate going forward. And so by increasing our expected costs, of course we've decreased our expected gains, and that's why you're seeing a 12% savings for this protected issue when the previous three were in the 21% range. And when we roll the principal in, you see that 12% increase to 15%, And again, it lags behind the previous 3 issues for the same reasons. And again, we want to be conservative. I think when we do these analyses, we don't want to get caught short. Now, this analysis essentially takes what we've just been talking about regarding one specific interest rate assumptions and provides you with 4 interest rate assumptions and compares them to that base bid or that base bond highlighted in yellow. What would happen if we issued the debt now at a fixed rate of 3% and compared it against 4 different interest rate scenarios? And Jean has excellently depicted scenario 1, 2, 3, 4, and 5. They represented in the columns 2 through 5. And in each of these cases, she's increased the interest rate across the columns, and of course also down as we're talking about what happens if interest rates move against us quicker than we're anticipating. And what we can see from this data is that as interest rates increase and start to cross the long-term debt line that we could have issued at 3%, we start to see our numbers go into the negative. And of course, it's depicted on the graph in our traditional black to red. Red ink columns start to show the negatives, and this is where you can see the risk that the town would have been better off issuing long-term debt at 3% if it feels that short-term rates are going to increase. And I think that is the core part of the decision process that the community needs to make. I want to point out on our next chart, in our final chart, what we think are some of the things people should look at as they're trying to make these complex decisions. This chart is the 10-year Treasury rate as compared to the 20-year Treasury rate. When we issue debt, 20-year debt, our rates are oftentimes a product of the 20-year Treasury note. In our scenario, we have 17 years left to issue debt, because we issued a 20-year note and we stayed in the short-term market 3 years. We can never exceed Chapter 44's allowance for the number of years we can issue debt for a particular project. So the longer we stay in the short-term market, the shorter we have an opportunity to go to the long-term market. And so while that can be a detriment in some cases, because if a community stays in the short-term market too long and doesn't make a principal payment, then the principal payments are going to be bigger because it's over a shorter period of remaining years. In our case, we're not concerned about that, because this is not about trying to avoid making principal payments. This is about trying to take advantage of our AAA rating and our low cost of borrowing and seeing if we could utilize that to provide savings to the taxpayer. I would point out that in all of this discussion, these savings are a direct benefit to the property taxpayer in Hingham, because all of this debt, or at least 95% of this debt, is tax-exempt debt that were voted as debt exclusions in general elections. So the taxpayers will be paying these costs above and beyond their ordinary costs. It's very important for us to try to minimize that impact. And what Jean has done here is showed the comparison to the 20-year rate to the 10-year rate. Why is that important to us? Because if we're issuing debt for 17 years and we stay in the short-term market for a period of time, let's say 7 years, we would no longer be comparing our notes to a 20-year Treasury, but rather to a 10-year Treasury. And you could see the 10-year Treasuries have a lower rate historically over the 20, which is obvious, for obvious reasons rather, that the longer you're asking to borrow money from somebody, the more risk involved, and the higher the demand for rate. That's a nice segue for me to conclude in challenging people to think not just about historical patterns, but about the reasons for interest rates to be where they are. I've been told for the last 5 years that rates are going to go up and that we should hurry up and issue this long-term debt now, because if we can go back to a chart much earlier that shows the short-term rates over the last 20 years, you can see that since 2008, short-term rates have been, and again, this is a national average, but our numbers have been about 15 basis points, and we tend to trade lower than the national averages when it comes to borrowing costs because of our natural AAA. And so the windfall to the town, the difference between the black line below and the pink line above, that's all gain for the taxpayer. And so while I do understand the concept that rates are really low and rates are likely to go up, I'm not so sure that long-term rates and short-term rates are going to move in the same directions, because there have been economies in this world that have stayed in this short-term market much, much longer than we have today, and our own marketplace has been surprised at the longevity down here. To me, I think the economic structure in the community, in the country, is going to be enormously challenged if rates move significantly north than where they are right now. And so I think there's some pressure downward on that. I also think that as we see interest rates rising, they're rising on the long-term level, not the short-term level. And you can see it right here on this graph, where in 13 we saw long-term rates move from 2 to 3%. Short-term rates didn't change. And to me, one of the things that's saying is that those that determine risk, the buyers of debt, are saying that they're not sure what the risk is long-term, but they're much more comfortable that short-term risk is more manageable. And that may lead to gains in the future, and we may be in a different economic model. What I don't want is the community to look back 10 years and say, oh, I should have done this. So this is an opportunity to look at it and see and make your decisions. And if we get to the point in 10 years that we looked at back and we didn't take this opportunity, at least we can say to ourselves, we looked at it, we made what we thought was a rational decision, and we're okay that we didn't get a gain. Thank you.